Welcome back to the channel. I'm Algabot, and this is where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. Today we're exploring a strategy called Clustered Volatility Breakout. It's a channel breakout system with a twist. It only takes trades when the market shows a very specific statistical fingerprint known as volatility clustering. By the end of this video, you'll understand the Donchian channel it uses, the volatility memory gauge that gates every trade, and how it manages risk with the average true range. Remember, this is educational information only and not financial advice. Let's get into it. So what exactly does this expert advisor do? At its heart, Clustered Volatility Breakout is a Donchian channel breakout system. A Donchian channel simply tracks the highest high and the lowest low over a recent window of bars, forming an upper and a lower boundary around price. When price closes decisively beyond one of those boundaries, that is a classic breakout signal. But breakouts have a well-known weakness. Many of them fail and snap straight back. This strategy tries to address that by adding a regime filter based on one of the most robust facts in financial markets, volatility clustering. This is the observation that large price moves tend to be followed by more large moves, and quiet periods tend to stay quiet. Statisticians call this the Arch effect, and it shows up as positive correlation in the squared returns of price, even when the raw direction of price looks close to unpredictable. The strategy measures this directly. It computes the lag-1 autocorrelation of squared returns over a rolling window, a value it calls rho 1. When that value rises above a set threshold, volatility is said to have memory, and breakouts are permitted. When it sits near zero, volatility is judged memoryless, and the strategy stays on the sidelines. Every trade is protected by an ATR-based bracket, a stop-loss, and a take-profit sized from recent market volatility. The system holds only one position at a time per magic number, and because the channel excludes the breakout bar itself, a fresh new extreme is needed before it will consider another entry. Everything is derived from simple open, high, low, and close data on a single time frame. This makes it a clean case study for anyone curious about how regime filters and volatility statistics can be layered onto a traditional breakout idea. As always, this is for educational purposes only. Let's walk through the logic step by step. The expert advisor acts once per completed bar. On each new bar, it first checks that it has enough price history to work with and confirms that no position is already open under its magic number. If a trade is already running, the ATR bracket manages it, and the EA simply waits. Next comes the regime gate. The strategy takes the last 30 returns, by default, and squares each one. Squaring removes direction and leaves only the magnitude of each move. It then calculates the lag-1 autocorrelation of that squared series. In plain terms, it asks whether a large squared move tends to be followed by another large squared move. That single number is rho 1. If rho 1 is at or above the ArchThreshold, which defaults to 0.20, the market is judged to be in a volatility clustering regime, and entries are allowed. If not, the EA stops here and takes no trade on this bar. Only once clustering is confirmed does the strategy look at price structure. It builds a Donchian channel from the channel bars immediately before the just closed bar, 20 bars by default. The highest high of those bars becomes the upper boundary, and the lowest low becomes the lower boundary. Notice that the channel deliberately excludes the signal bar itself, so a genuinely fresh extreme is required to arm an entry. Now the entry conditions. For a long, three things must line up. Clustering is active. The just closed bar closes above the upper channel boundary, and that bar is itself bullish, meaning its close is above its open. For a short, it's the mirror image. Clustering is active. The bar closes below the lower channel boundary, and the bar is bearish. Finally, risk management. The strategy measures the average true range, a simple average of recent true ranges, to gauge current volatility. On a long, the stop loss is placed 1.5 times the ATR below entry, and the take profit 2.5 times the ATR above it. That's a reward to risk ratio of roughly 1.5 to 1. Shorts use the same distances mirrored. One position at a time, and a fresh extreme resets everything. Let's look at the actual MetaTrader code so you can see how these ideas translate. At the top are the input parameters you can adjust in the strategy tester. RetPeriod, defaulting to 30, sets how many returns feed the autocorrelation. Channel, at 20, is the Donchian length. ArchThreshold, at 0.20, is the minimum clustering value needed to permit any entry. ATR period is 14, and SL multiple and TP multiple at 1.5 and 2.5 size the stop and target from the ATR. Just below, the code calls squared return autocore and stores the result in row 1. The line that reads clustering equals row 1 greater than or equal to ArchThreshold is the gate. If clustering is false, the function returns immediately and no trade is considered on this bar. Then it reads the just closed bars close and open at shift 1. The first block is the long side. You can see the condition. The trigger close is above the upper channel, and the trigger close is above the trigger open, a bullish breakout. When both are true, it reads the ask price, sets the stop loss at entry minus SL multiple times ATR, sets the take profit at entry plus TP multiple times ATR, and calls trade.buy with the fixed lot size. The second block is the mirror image for the short side. Here the trigger close is below the lower channel and below its own open, a bearish breakout. The stop loss sits above entry, the take profit below it, and the code calls trade.sell. Both sides normalize their prices to the symbol's digits before sending. It's a compact, readable structure, and everything is computed straight from price data. Now let's bring it all together on a chart. On screen you can see a candlestick sequence with the Donchian channel drawn as an upper and a lower band around price. Below, in the subpanel, is our volatility clustering gauge, the lag 1 autocorrelation of squared returns, which I'll call row 1, with a dashed threshold line at 0.20. Watch how the two work together. We begin on the left in a quiet, sideways stretch. Price drifts back and forth inside the channel, and crucially, look at the gauge below. It's sitting well beneath the 0.20 threshold, down in the memory-less zone. Volatility here has little memory, so even though price is bumping around near the upper channel, the strategy takes nothing. This is exactly the kind of low-conviction environment the filter is designed to skip. Then the character of the market changes. As we move toward the sixth candle, the gauge climbs and crosses above the 0.20 threshold, up into the clustering active zone. Volatility now has memory. Recent moves are getting larger and grouping together. On that same breakout candle, price surges and closes above the upper channel boundary, and the candle itself is strongly bullish, closing well above its open. All three conditions are satisfied at once. Clustering is active, the close is above the upper channel, and the bar is bullish. The EA signals along, and you can see the buy entry marker appear. From there, notice how the trade has room to run. Because volatility clustering suggests large moves tend to be followed by more large moves, the breakout doesn't immediately snap back. The next two candles push higher, extending the move, until price reaches the take profit target, which was set at 2.5 times the ATR above entry. The take profit marker shows where the position closes in this illustration. That upward burst is the clustering idea playing out on screen. Now watch what happens next. After the peak, price stalls and forms a small consolidation near the highs. The gauge stays elevated, above the threshold, telling us volatility still has memory even as price pauses. This sets the stage for the mirror image short. On the breakdown candle, price rolls over and closes below the lower channel boundary, and that candle is clearly bearish, closing below its open. Once again, the gauge is above 0.20, so clustering is confirmed. All three short conditions line up. Clustering active, close below the lower channel, and a bearish bar. The EA signals a short, and the sell entry marker appears. Just like the long, the short is given room to develop. The clustering regime suggests this downward move is more likely to continue than to instantly reverse, and indeed the following candles push lower. Price travels down until it reaches the take profit target, placed 2.5 times the ATR below entry, and the second take profit marker shows the position closing in this example. Step back and look at the whole picture. Notice what the gauge did for us. In the early, quiet section, it kept us out entirely, filtering away the choppy environment where breakouts so often fail. Only when volatility developed memory did the channel breakouts become actionable, and both the long and the short unfolded during that clustered, high-memory regime. That's the core idea. The Donchian channel decides direction, while the volatility clustering gauge decides whether the breakout is worth taking at all. Of course, no filter is perfect. Breakouts can and do fail even in clustered regimes, stops get hit, and losing trades are a normal part of any strategy. What this chart illustrates is simply the logic the code follows, not a prediction of how any given trade will turn out. Real markets are messier than any single diagram, which is why careful testing and thoughtful risk management always matter. And that brings us to the end of our look at Clustered Volatility Breakout. Today we unpacked how a Donchian channel breakout can be combined with a volatility clustering filter, measuring the memory of volatility through the lag-1 autocorrelation of squared returns, and how the strategy manages every position with an ATR-based stop and target. We walked through the rules, read the MetaTrader code together, and traced both a long and a short example on the chart. Remember, everything in this video is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. If you found this breakdown helpful, please like the video, subscribe for more MT5 strategy analyses, and leave a comment telling me which strategy you'd like to see next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.